This is All India Radio. In the program Spotlight, now we bring you a discussion on RBI monetary policy decisions. The participants are Udayan Ray, economic analyst, and V. Ravi Kumar, AIR correspondent.
In its bi-monthly policy meeting, the six-member Monetary Policy Committee of the RBI today announced a 35 basis point increase in the repo rate to 6.25%. In order to understand the implications and ramifications of this decision, we are joined by financial expert Udayan Ray. Udayan, the RBI governor today called India an oasis of calm among global turmoil, but also said that the biggest risks to the outlook continue to be headwinds emanating from protracted geopolitical tensions, global slowdown, and tightening of global financial conditions. In this context, how do you see the decision of 35 basis points hike?
The governor actually summarized something that we are all aware. And most of the commentaries have been from RBI and other places have been talking about this. But the interesting part of it is that this is a 35 basis point hike. And this is obviously, in terms of quantum, it's a much smaller hike. The previous three hikes were 50 basis points, as we are aware. So this actually illustrates what the governor actually said. To paraphrase him, that the worst of the inflation is behind us. So they think that the peak of inflation is probably behind us, and but there is a lot of work to be done, and they are looking at bringing it back into that. He's used the term shepherding inflation within that zone which our RBI operates. So that is the first take that one can have, that yes, in our country, the Reserve Bank or the central bank is signaling and formally saying that the inflation is slowing down, but still it is not within the zone of comfort, and it intends to keep working on this issue and till it gets into control within its established norms or bands, etc.
So you mentioned inflation, and the MPC has retained its inflation forecast for the current financial year at 6.7%. Though the current and next quarter inflation forecasts have been increased by 10 bips, the RBI governor stressed on persistent price pressures and the stickiness of what he called core inflation, which obviously strips away the volatile components of food and fuel. So CPI has been above 6% for 10 consecutive months. So how do you view the inflation assumption of the MPC in this context?
When you very rightly mentioned the 10 months, because that's an important thing, it's showing that it's sticky, it's showing that it's obstinate, and it shows that it will take some doing for it to go away. Now, as we are all aware, most of the inflation on China, almost all of it has been coming out of supply sort of related issue, whether it's oil, which has got oil markets, energy markets which have got disrupted and prices have gone through the roof, or it's food in other countries. So there's only so much you can do in terms of managing inflation without calming down or, pushing down or slowing down the demand, shall we say, without hurting it too much in the long term. So it's a very delicate sort of a balance that you have to do. You have to control the inflation and not hurt the economic growth. And if you see all the statements that have been coming out from RBI today, is doing a fine balancing act between the two. We're going to make sure that liquidity comes in, basically not to harm growth, yet we're going to address inflation. So it's like a circus artist who's on that rope with that bar sideways and trying to balance. It's a very difficult balancing act, but as the governor said, that the worst is behind us.
Right. Tough act, funambulism as they call it, tightrope walk. But in 2022, we have seen a total rate hike of 2.25%, 225 basis points, and the governor said that their rate decision is largely predicated on domestic factors. And we know the US Fed Reserve is expected to meet next Wednesday for the last time in 2022, and normally they do those massive 75 bip hikes, but this time the expectation is a 50 bips hike in the US Fed Reserve. So their rate would probably end up in the range of 4.25 to 4.5 exiting in 2022. How much do you think the Fed's decision would impact India, although the governor said that our decision is largely predicated on domestic factors?
Yeah, of course, it's predicated on domestic factors. Nobody's going to dispute that. But let's be honest. I mean, we are a globally integrated economy. Okay, fine. We may not be accounting for a very significant portion of overall global trade, but we are, whether it's our key inputs like oil or, edible oils and stuff like that, or, we are exporting. So we are globally integrated. So we are not untouched by them. Especially our currency is not untouched. Every time there's going to be rate tightening sort of information or it gets tightened in the US, our currency, which is the rupee, does come under pressure. So it's not going to remain untouched. The other important point, all the rate hikes, they typically take a little bit of time to show up on the ground. Transmission takes a little bit of time. Now, typically people talk about, somebody would say 6, some 7, 9. So, if we assume it's going to be 9 or 10 months, so those effect will start showing up not now, but maybe in the first quarter or the first 4 months of 2023. Now, that is when we'll get some idea of where we are heading. And that's also the time when we'll get some idea where what Fed is going to do. So for an equity market investor, a person who's investing in stocks or directly or indirectly through mutual funds and other routes, that is the time when they'll get a very clear idea where the direction in which the markets are going to be moving, and they would be able to take far more informed and considered decisions compared to the kind of volatility that we have seen for more than a year now.
Right. You mentioned the equity markets. The equity markets in the morning were slightly up, but after the decision, it's been downward almost. The Sensex lost over 200 points today. And the debt market, also you see the 10-year benchmark bond moved up by almost 4 bips and ended closer to 7.29%. So what does this indicate? Both the debt markets and the equity markets have reacted very clearly to this decision. So is it something they were not expecting?
While the 30 basis points, Ravi, is something that they were expecting, you would have seen it in all the newspapers. They've all seen it. But the commentary turned out to be a little more hawkish than people, the markets would have liked. All right. So from the debt market side, the borrowing and all that, in terms of growth, you're looking at those things. The debt market side, equity, you're looking at, okay, that means there's some more compression in terms of economic growth. And since our index, our indices are overweight on banking and financial services, it's clearly their margins are going to be under significant pressure in the first quarter of 2023. Because those RBI moves are going to now show up. So that might have been factored in. Rate-sensitive sectors, their prospects might have been factored in. So this could be a mix, but some of the first few factors that I mentioned might just have come into play.
Earlier you were talking about transmission, and pace of transmission has always been a concern. So while loan rates go up quickly, the deposit rates don't keep pace, or at least that's the general impression people have. And the governor said in a statement that the weighted average lending rates on fresh and outstanding rupee loans have increased by 117 bips and 63 bips respectively during the period May to October 2022. On the deposit side, the weighted average domestic term deposit rate on fresh and outstanding deposits have increased by 150 bips and 46 bips respectively. So you mentioned that it takes some time for the rate increases to transmit. So somebody who's probably looking at making fixed deposits, should he wait for 2-3 months before the full effect is felt, or should he go in and lock in his fixed deposit right now based on this today's 35 bips hike?
Well, what can be done, Ravi, is a favorite move by a lot of people. They establish what is called a ladder. So you don't put in all the money together, and you probably would do if you have a reasonably large sum, then you break it up into a couple of parts, and you do one now, or maybe one now, 2 months later, 2 months later, so that you can catch some of the hikes if you think that's going to happen. So laddering is something that one can look at. But the truth also, Ravi, is this, that inflation always beats FD rates. If you look at the last 10, 11 years, on an average, especially if you take 10 years and look at the last 5 years in that decade, you will see that FD rates have been getting a hammering from inflation. So on an average, they don't do very well over a long period. So if you're looking at FDs and you have to invest, then look at shorter tenures because the movement is going up. And if you can, then look at some of these bonds, which are secure bonds, which have a variable rate, so we can catch the upside in terms of interest rates.
So in terms of FDs, you think that FDs generally, in your estimate, it might not be able to beat inflation. That's your estimate going forward?
Yeah, if you look at 3-year FDs over a period of 10 years, and if you keep seeing how they have behaved with respect to inflation, it's been an absolutely precipitous decline. If you look from 2011-12 onwards, and it's been just going down, and it absolutely hit the nadir somewhere around 2020. And it's been some kind of a rebound, but it's not exciting. I mean, it's not disheartening actually. And it's been trailing behind inflation. So it's not proving to be a great, you're actually paying the bank for, the fixed deposit. You're actually losing money in the last 2 years. So that's something one has to be a little careful about. But if you look at some of the other instruments like the GOI bond, Government of India bonds, which are linked and they give you an upside over GSEC rates, they might just be a little better, but they have a slightly longer lock-in period. So one needs to look at the tenures. So, but if you cannot lock in for a long period, then also don't then, keep the tenures for your FDs a little shorter so that you can switch from one to the other and you don't get stuck onto a lower rate when things are going up, So that's the idea.
So the RBI governor in his statement had mentioned that the Forex Reserves have gone up in the last 1 month. But if you look at the differential in the rates between the US Fed and the Indian one, currently we are at, I think, 6.25% after this rate hike. And if we assume there is a 50 bips hike in the US Fed in next week, then they will end up at around 4.5%. Is that enough differential to avoid a flight of money from India to US?
Ravi, this is a personal opinion. I have absolutely no doubt that every time the US Fed is going to hike rate, we are going to face pressure. Every emerging market is going to face pressure. I don't think there's a person worth the salt who can say that with confidence, give you the reason why something otherwise will happen. So that pressure will always be there. But the good news is most of this pressure that we have gone through would start abating from, say, March, April onwards. At least that's what the US markets are factoring in. So if that starts happening, then things will ease up. So we have roughly another challenging 4 months or so, after which things at a personal level, I would expect things to calm down. But as the governor said, geopolitical and other factors are there. So they are like, as economists call exogenous variables. You don't know which way things will turn.
Right. Another thing I noticed, World Bank yesterday had revised India's GDP growth forecast upward to 6.9% from the earlier 6.5%, whereas today RBI reduced the growth forecast from 7% to 6.8%. What should one infer from these two decisions?
That's a good one, Ravi. Well, one should infer that most of the people are expecting the growth rate to be around 6.8 to 7%. If you remember, just a couple of days back, Standard & Poor's, which is a leading global rating agency, they were talking about 7%. So that's what consensus seems to be moving around that 6.8 to 7% region, and which I think where we'll head, because there's nothing in terms of domestic consumption and some of the other factors. We are not seeing things that can go dramatically south. But of course, large-scale disruption in energy markets, global political tension, they could all alter the situation overnight, as we have seen in 2022.
And in your expert opinion, Udayan, you must have gone through the entire statement. Is there anything that came across as a surprise, probably while reading between the lines? Anything that you think that people might have missed?
No, not really. I mean, while it's a question of what you were expecting, markets were expecting certain things. They wouldn't have wanted the language to be in a particular way. I don't think the statement was an issue. I think some of the things that were said in the press conference is what possibly the markets have reacted to. They probably found it a little more hawkish than they would have liked. But that's what the issue is. The RBI is actually doing a delicate balancing act that we discussed. And when you're doing that, but what is unambiguous is, according to RBI, the inflation issue or inflation is it's abating. So that's a good point. That's something at the end of the day I would settle for, and that gives one optimism, especially equity investors. And then the fact that it's not in a runaway zone as it is in Europe and some other parts, that's also great. So then we just have a couple of months to ride out, and then we can look for a slightly more visible and a little more certain sort of factors or ecosystem within which you can go and invest.
Right. One more thing that I noticed in this statement is the reference to imported inflation, and the RBI statement assumes an average crude oil price of $100 per barrel and says the risks are evenly balanced. So do you think this assumption has enough margin of risk? Currently, we are looking at $80 to $85. Do you think $100 per barrel is a safe margin of risk?
I think it is, because if you remember, Ravi, when the conflict started in Ukraine, it first shot up to, it was as if there was no break. Then this was the range, 100 to 105 was the range that it, moved around for some time. So it's not a bad range to be in. If you're looking at a price range which is higher than that, it's immediately going to affect global demand. There's no doubt about it. So I think it's not a bad assumption to have, because anything above this is obviously going to start killing demand, which the oil producers are not going to like.
Udayan, thank you very much for joining us on the program and helping us understand the RBI MPC decision better.
Thank you, Ravi.
You were listening to a discussion on RBI monetary policy decisions. The participants were Udayan Ray, economic analyst, and V. Ravi Kumar, AIR correspondent. This program was produced and presented by the News Services Division of All India Radio. You can listen to it on our mobile app, News on AIR. This program is also available on our YouTube channel, News on AIR Official. You may email your opinion about this program at airnsdtalks@gmail.com.